Hi, everyone. It's PJ Patterson here for a market update. Today is the 17th of March, already halfway through March. Unbelievably, it's Wednesday, which is hump day, of course. We're now on the downward slope for the week and getting close to Easter and all the lovely little holidays that happen in April, of which I'm looking forward to having a break. Going to be doing a lot of baseball over that time. Got some big tournaments coming up, so hopefully you'll hear more from me about hopefully earning another return trip with a senior league team this time to the Nationals, but we shall see. A lot of work to be done before then. Top three things today are, number one, yellow lights. So we've started to see a couple of things that are flashing a little bit of a warning, but I'm going to go into that and tell you why I'm not at the moment yet particularly concerned about that. Number two will be energy. And really, that is to say inflation. Just going to revisit that again. Last night, I loaded up big time on energy stocks. They gave us a fantastic buying opportunity. I'd sold a little bit of energy and some other things last week, so I had plenty of cash in accounts in your account to do that. So I'm very excited about that. And finally, just to reiterate and kind of go through a couple of quad two things. And to follow on from item number one, which is the yellow lights, just explain why I think we're still well and truly in quad two. So the first thing I want to highlight here is there's a couple of things that have shown lower highs. The Kospi, which is Dr. Kospi, which is the South Korean stock index. And you've heard me talk about Dr. Kospi before, I'm sure, for those of you that are longtime watchers of these updates, and Dr. Copper, both very important indices, and particularly in the case of copper, very important commodity to sort of suggest the health and what's going on and what's maybe predicted to happen in the global economy. And remember, the market usually gets this stuff right. However, there can be short-term periods where the market maybe runs a little bit too far ahead of itself, consolidates and pulls back shortly before launching higher again. You can sort of see that on this chart, I suppose, where copper had a big move beginning back in November of last year, big move up. Then it sort of consolidated a little bit, came down just a smidge, and then had another massive move up at the beginning of this year, and really through probably most of the month of February was moving high, and even as recent as probably around March last week, so March 13th, 14th. And it's just pulled back a little bit, but it has signaled a lower high, as has the Kospi. Same deal, massive run, but a sideways movement. Down a little bit, and there's a question mark here on this chart because this is the yellow light. This is something that we're observing in the moment of global macro, which is to say, these things are come off a little bit. They're signaling lower highs, and that's a big thing to be watching for in the sense of a trend and a market, is to see if it starts to signal that it could have a lower high. All it is right now is it's a warning to say, we're just going to observe. And I use the term OODA loop from time to time. So what that stands for, it's short for observe, orient, decide, and act. Well, we're in that observation phase right now of saying, okay, is this just a short-term correction in part of this longer-term trend, or is this possibly signaling a phase transition? Now, that's a key term in global macro, particularly the way I do things, because one of the things I'm looking for you and our positioning is to see if we're about to go through a phase transition, because a phase transition basically means we're moving from one quad to another quad. And when that begins to happen, what we have to do there is to, first of all, identify which quad it is that we're moving towards, and then reposition the asset mixture to weight the assets that are have the highest probability of gain for that particular quad. So in other words, put on the playbook for that quad. Now, I wanted to talk about all of that, and I'm actually going to move I should have had item number 3, quad 2, as item number 2. So I'm going to skip item number 2 for a second, which is energy and inflation. I'm going to go straight over to a couple of slides and tell you why I think we're just in a short-term consolidation phase. If we put this in context, the market has run pretty hard, pretty fast through January, February, and a little bit of March. We've had massive gains in a lot of things. The Russell, energy, financials and a few other things, particularly in small cap stocks and even growth stocks for that matter. So my argument there is to say that we've probably pulled forward some of the expected returns and things like that we're going to get through the middle part of this year. However, we have some big events still coming up, and this is a chart of the U.S. GDP year-over-year projections. This is from Hedgeye, and pretty much what it shows you, and I've talked about this before, is in quarter two there is going to be a GDP print that has not been seen since post-World War II in that 1950 timeframe when it was up, I think, around 11 or 12%, something like that. And so sort of a once-in-a-career, maybe even once-in-a-lifetime type GDP print. Now, if we see this print, it's going to get a lot of people then moving money into the market because they're going to be thinking, oh, yep, we're totally out of the woods from COVID. Everything is now hunky-dory, and we're going to see, some really good GDP figures going forward. Probably not 10%, in the next quarter after that. Now, as you can see here, it's predicted to drop back to a more normal sort of 3 to 3.5% growth range, which is still a far sight better than what we were seeing during the COVID crisis or last year. But as you can see from these sort of trending GDP figures, it's probably still a little bit high, and factoring in all of the changes that we've seen, not changes rather, but the reopening of the economy. So in any case, we have that coming up again, which is why I think this is just a consolidation period to then see the market move higher. The second thing that is suggestive of that is the fact that we have yet to see inflation fully priced into the market. So as you can see here, we've started to see the inflation prints moving higher through the fourth quarter and first quarter of this year, and then we're going to get a massive inflation print or a projected inflation print in both the second and third quarter of 2021. Now, again, this is beginning to really be priced into the market. We haven't really seen it fully priced in yet in things like energy and other commodities, but as I've shown other charts, I don't know if I have any other charts here of the commodities index. I'm just going to see quickly. I don't. No, not in this chart pack do I have that. But this would be indicative. This is a bit spiky because copper did have sort of a parabolic move through February. But if you remember, charts of the CRB that I've shown you is it's moved quite steeply from left to right up from the left to the right. So basically suggestive that we are, demonstrating that we're in a bull market in commodities, but certainly suggestive that that is currently the case. So just going back to this. So again, my argument here is that we still have not seen the GDP print or the inflation print, which is going to continue to drive the Quad 2 playbook. Now, the final thing to say about this, of course, is just to reference our predictive model stuff here, where, again, quite clearly, if you look at quarter one and quarter two here, the whole world is basically Quad 2, except for China. And I've mentioned China in my last update, and I sold out of the full China position that I had on because China is looking like it's beginning to slow, and we're seeing that it's going to be entering Quad 3. So it's not necessarily something to be worried about at this stage, because China was, of course, one of the first countries to get out of the COVID crisis. So they were in, if you just go all the way back here through late 2019 and 2020, they were sort of in Quad 3 territory, but then very quickly got into that Quad 1 stance because they just pumped a ton of money in and did a whole bunch of stuff around liquidity, et cetera, and got themselves out of the Quad 3 and 4 damage that had been occurring in the first and second quarter of 2020 for most of the world. And so it's probably no surprise then that they're going to be the first to enter that Quad 3 scenario. And we don't have to worry about that really in Australia until probably the third quarter, where right now we're showing that we may re-enter Quad 4, which of course will mean a total shift and change in the playbook. But we'll get to that when we get to that. Right now, we've still got to get through the second quarter, finish the first quarter, first of all, which is this final month of the first quarter, and then get into the second quarter. So that just leads me to the final thing I wanted to talk about today, which was energy. Last night, we saw a huge buying opportunity in energy. And I'm just going to grab put this on the screen. Here we go. So last night, there were a number of things that sold off. And what you can see here just quickly on the screen is all of these top names, except for XRT, are sort of energy companies. So XLE is the energy ETF. I bought more of that, bolstered up position in that last night. It was down 2.8%. It's pretty much at the low end of its range at the moment. And all these other components of the XLE, so that's ExxonMobil, ConocoPhillips, Occidental Petroleum, Chevron, Diamondback Energy, and a couple of others. Halliburton, I think I bought all of these last night. As you can see, there's varying degrees of decline in some of those. Energy is still lagging in the sense that it has not, oil has continued to rise in price, but the energy companies have yet to see the earnings flow through. But this is going to start to get priced into the market. And I suspect that by the time we get to the second and third quarter of this year, there's going to be a major ramp in energy. And we're going to get back to sort of the previous highs that we saw even a year or two ago in many of these stocks. And we've got another 25 to maybe 30% of upside in the energy trade. So it's definitely a place that we still want to be. However, along the way, we're going to get some pullbacks and it's going to run a bit too far. So there'll be opportunities for me to do what I like to call feeding the ducks. But in any case, just so you know, that's why you would have seen a bunch of trade stuff come through overnight, because I reloaded on energy positions. So I'm quite excited to see how that plays out, because oil was getting down near the bottom end of its risk range, as was, again, the XLE and, of course, the components of the XLE. Now, a couple of other things to highlight for you. And this is one of the reasons why I raised cash a week and a bit ago, because we had, first of all, we've had the markets moving slowly higher off the back of declining volatility. So, you know, I talk a lot about volatility. It's one of the key measures, key drivers of market increases and decreases. So, or I should say, market run-ups and market sell-offs. So the VIX index right now has come back from, let me see if I can get this chart a bit more on the screen. That's a weekly candle. Let me just get this onto a daily. So the volatility index, as you can see, has just steadily declined since early March. And so it's no surprise that we've been seeing new all-time highs, things like the Russell and the S&P 500 and even the Dow. Technology, however, have suffered a little bit because we've continued to see rates rising, and the big secular growers like your Amazons don't necessarily like higher interest rates, which is why we've seen companies like that selling off. So tech broadly has been hurt by higher interest rates. Now, tech loves a low interest rate environment, and I was actually just reviewing with one of my team this morning some of the sector performances over the last year, even year and sort of 3-4 months of certain market components based on what was going on. And interestingly, the tides have turned with something like tech and energy. So last year, energy was down something like 40% year to date. That was as at like December 24th, whereas tech was up like 25, 30%, something along those lines. And now that's reversed. Tech is actually down this year about 12 to 15%, and energy is up about 30%. So it's just very interesting to see how different asset classes or sectors will reverse or will either benefit or not benefit, or suffer, probably is really the word to use there, because of the environment we're in. So, and it's another reason why I started to reduce tech exposure, because of that signal that came about a few weeks back. So I still haven't taken off all the Australian tech plays. I may very well do that in the next couple of days because of the interest rate movement. Same thing's going to happen in Australia. So I'll just see about that. But anyway, highlighting VIX. Sorry, that's what I was talking about. The VIX is now at the low end of its risk range. It's just dipped below 20. This is not a time for me to be allocating a bunch of, broadly speaking to the market, a bunch of capital. So right now, today's setup is the S&P 500 has about 6-to-1 downside. Now, don't worry about all this stuff that I'm saying. All you need to know is really just key in on the VIX and the fact that the VIX risk range right now is basically 20 to 30. It's in the chop bucket. And we need to see the VIX drop really, if we want to see this bull market just really continue to ramp and probably have that blow off, we need to see VIX drop below 15. So we're not there yet. And so what I'm suggesting may very well occur over the next week or possibly 2 weeks is that the VIX could get back up to, the low 20 range. So sorry, the high 20 range. So 28, 29, something like that on the VIX. Now, if that happens, we're going to see a sell-off in the markets. That's just the way these things work. And one other thing I'll just quickly revert back to here is our good old implied volatility information, where, let me just get that open. There we go. There's our implied volatility chart. And again, when we start to see a lot of discounts or just very, very small premiums, again, it's a sign of that we need to be cautious. And look here, in the S&P 500, we have a discount of minus 6%, again, which, the S&P is hitting new all-time highs or have done. The Russell has a discount, whereas a week ago it was a nice premium. Same with the S&P. A week ago was not a fat premium, but it wasn't a fat pitch, but it was still a premium. But they've swung to discount. And again, this is a warning sign that we need to be very cautious in markets. So all told, there's a lot of little things that add up to big things, a big thing. And the little things are volatility has gone to the low end of its range. We're seeing implied volatility discounts in markets. We've seen a couple of markets like the Kospi, like copper. I think Japan is also in that situation where we're seeing some lower highs. So it's just one of those times to be cautious, to take some money off the table, to cash up, and then redeploy capital to other places where we get a buying opportunity. And again, as I mentioned a moment ago, energy has basically served one of those up. And I didn't take full allocations to positions, but I may very well increase the allocation to energy if we continue to see a little bit of a sell-off. And I'll do that incrementally, maybe 5 to 10%, something like that at a time, until we get to a full allocation. So all told, I'm still confident that we are absolutely in quad 2, but I'll be data dependent on that. I reserve the right to change my mind. I'm not going to tell you some narrative or story that I think is going to last for the rest of the year. I always reserve the right to change my mind based on new data and new information. But as it stands right now there's a couple of yellow lights flashing, lots of green still, nothing red as yet. Interest rates are still moving higher, which is going to potentially cause further sell-offs in technology. But inflation is still the story of the day, as I've already gone through. And those are going to get continued. And the inflation expectations are going to continue to get priced into bonds, which is why interest rates are rising and the bond prices are falling, and commodities broadly. So, but especially the energy trade, which has been a little bit of a laggard over some other stuff. So that is probably all I need to say about that. I've actually kept the market update under 20 minutes. How about that? Not a lot to say. Just keep an eye on your fries, which I, of course, am doing every single day. I'm bolted to the chair, analyzing and looking at this stuff and making the appropriate trades. If you do have any questions, put them in the comments or book yourself in for a call. If you want to review anything, you can do that through the boardroom. And if there's anything else I need to announce, I don't think so. That should be it for today. So I will come back with any updates if anything big occurs in the next couple of days. Pretty unlikely. We've got a Fed meeting coming up overnight. They'll probably just reiterate their calls on growth and inflation and probably really say a bunch of nothing. But it will be interesting to see whether we get a little bit of a sell-off in the S&P, and it very well could be triggered by something that Chairman Powell says that is perceived by the market. So just keep an eye on that over the next couple of days, but don't panic. Of course, if it does happen, our portfolios are pretty much set up right now in a cautious sort of stance, but looking to capitalize on that continuing inflation trade. So I think if anything, we might get some great buying opportunities for stuff over the next couple of days, and I will absolutely be capitalizing on that. Have a great rest of the week, and I will talk to you, no doubt, again next week. See you later.